Good morning. This is Caesar Farfan, the Head of Distribution for Perennial Value, and welcome to today's Perennial Live webinar. What's happened to value investing in this momentum-driven market? With me, I have my colleagues, John Murray, Managing Director and Portfolio Manager, and also my colleague, Stephen Bruce, who's a Deputy Portfolio Manager for the Perennial Value Australian Shares Trust. Just before I pass on to John this morning, just a bit of housekeeping. So you might be able to see, or you should be able to see on your top right-hand corner, there's a little orange button. That's the navigation panel. So you're currently all muted, so you can hear us, but we can't hear you. However, if you scroll down that panel, you'll see that there is a section where you can type in questions. We encourage you to type in as many questions as you would like. And what we'll do is, towards the end of the presentation, we'll address all of those questions. So on that note, I'll pass over to John Murray.
Good morning, ladies and gentlemen, and thanks very much for your attendance. And so I've got Steve Bruce here as well. Too many of you will know Steve. So let's just roll through the presentation. I guess the first comment to make there, and probably no surprises here, markets have been tough for value. I must say this is, from my perspective, as a true to label value investor, this has been one of the most difficult periods I've been through, and it hasn't been with a lot of joy either that we've gone through this period. We're investors in our own funds as well as you. As you all know, and we would love to have done better, but we'll talk more about the forces that's sort of been at play against value over the next few minutes, and then give you a sense of where the portfolio is sitting now and how it all looks going forward from here, which is really all that matters from this point on. The chart you have in front of you there, it's a star chart which is done by UBS, which some of you may have seen before. And there's a lot on that, but to cut a long story short, down the left-hand side there, you can see different, if you like, stars, value, quality, momentum, and so forth. And then you'll see different colours. Red is where a star's been out of favour, and the darker the red, the more out of favour it is. And then the blue is been where it's in favour, and the darker the blue, the better. And I'll probably highlight to you two key points there. You can see value just generally there's been out of favour. Dividend yield, for example, has been very much out of favour. And as you know, Perennial Value, we've always liked our dividend yield. We like to deliver a combination of capital growth and running yield in terms of distributions over time. And then if you go down sort of almost 2/3 of the way down here, you'll sort of see momentum and growth, very much the flavour of the month. And in fact, if you look at price, momentum and growth, it hasn't been flavour of the month, it's been flavour of the last 5 years. So value as a style has underperformed for the last 5 years, and I think that star chart gives you a very, very good sense of that. It's been a source of a major frustration for us. We'll talk about this in a few minutes' time, but over the last 5 years, we've kept pace with the market. We've neither outperformed nor have we underperformed. And I'll talk a little bit more about that later on. I think in summary, and sort of jumping ahead somewhat, the macros conspired against us. We'll talk a little bit more of that in the next few minutes. What we can influence in terms of our true to label value style, in terms of stock picking, we feel as though that's been working quite well. But moving on, so why have they been tough for value? Well, interestingly, some of you may have attended or about to attend the FPA Roadshow, and myself and Caesar and Steve, we've been sharing the roadshow, but we've been talking about active and passive. And we've been talking about the macro factors that have conspired against active investors, including value investors, really since the GFC, and which really points to this chart here. So you've got, the quantitative easing globally, and also very, very low interest rates. And what we've seen, and what we all know, has been, a global phenomenon, and as we've experienced here in Australia as well, as that low interest rate environment has driven a demand for bond-like equities. And again, we'll talk about some examples in a minute. Subdued growth environment, high growth stocks have been very much in demand. So where investors have made the call that they think that stocks are will be experiencing high profit growth, they've really been willing to pay any price for that. We'll talk about some examples in a minute, and it goes back to that previous slide there where we saw price momentum, share price momentum being very much in favour for the best part of the last 5 years. So that environment's not suited to an investment style which is based on valuation disciplines where you know, it seems to me that many investors, both here and globally, have sort of been paying any price for high growth stocks. As you know, that's not the way we invest, and we have stuck to our valuation disciplines during this period. So we have stuck to our knitting. But the other interesting thing too, you've heard us say many times in the past that, you know, balance sheet strength really important to us. Again, we'll look at an example in a minute. Investors have not been very discerning in terms of looking at quality of balance sheets. So it has been, of course, those macro drivers that sort of fed through into the sort of stocks which investors have favoured for the best part of the last 5 years, both globally and locally. You know, we all know this example here of Transurban. Really, when you go back over that over a number of years now, and this chart goes back to 2013, that there's a couple of lines there, but broadly that you know, there's a 50-day moving average, 200-day moving average, and a share price move as well, which is the blue line. But if you drop to the bottom, so this has been one of the stocks that's sort of been very much in favour during that period. Underlying assets, good quality assets, we all know that, and I think that's one of the interesting themes of a lot of these stocks. They've all got good quality assets underpinning them, but where it starts to get problematic, at least in our view, is around valuation and also, you know, balance sheet strength, picking up the 2 points we mentioned in the previous overhead. And you can see there expensive valuations. The numbers really do speak for themselves. But also in terms of gearing, there's a number of ways we look at gearing. Net debt to equity, which is that 226%. Net debt to EBITDA, which is earnings before tax, depreciation and amortization. It sort of measures a relationship between net debt and cash flow in very simplistic terms. You know, the higher that number, the worse. So, you know, in our way of assessing gearing, very, very high levels of gearing and unbelievably expensive. So I think that's an interesting instance of that. And to continue that theme, you know, looking at PEs for some of these other stocks as well. And again, you know, it's interesting when you think of our criteria. We're looking to buy good businesses for good value. Well, these stocks ostensibly do get the tick for good businesses, but obviously it's a valuation issue that's been problematic for us. And it really has been quite incredible, and this is, I suppose, you know, the part of the frustration that we've been experiencing over the last little while. You can see that group of stocks there, average P of 13 times. You know, that's twice the market. We'll talk a bit about overall market valuations in a minute. But, you know, look at the average 12-month return of that period of that group of stocks. It's absolutely phenomenal. 40%. And so when you think back to that earlier star chart we talked about, these are all the stocks that have been picked up in that sort of share price momentum, dark blue, in fashion trend over the last little while. You know, it's up 40%, and the market's up only 6%. Now, and you know, just on that, I mean, CSL PE 12 months ago, to explain why we went in there 12 months ago, was trading on a PE of about 25 times. TWE was trading on a PE of about 22 times. So again, expensive even 12 months ago. So that momentum just been continued. It really has been quite staggering. That's never sustainable. At some point, you know, I think we've all seen in the past, and we saw recently with A2 Milk, didn't we, where stocks are priced to perfection, and in our view, these stocks are predominantly priced to perfection. It only takes something little to go wrong to experience quite significant deratings. Hasn't happened yet. Well, we got a bit of a snapshot with it with A2 Milk. And we've seen more recently, just in the last month or so, with TWE concerns over their ability to keep supplying into China. So, we've had a couple of little windows there where these stocks can get hit if they're priced to perfection. Let's just dig a little bit deeper. And what we've got here is what's driven our portfolio, and this is sort of basis points impact. And we've had plenty of winners over the last 12 months. So our stock picking, to the extent of the stocks that we control in, i.e. good businesses for good value, have worked well for us. And that profile there, I won't go through them all, but BHP, Janus Henderson, News Corp, Macquarie, Rio, and so forth. That's the sort of profile we'd want to see. As you know, we don't bet the house in any one stock. We'd rather a group of stocks, add value across the portfolio. And in itself, that's a very, very reassuring profile. So we've had some good winners there. But again, turning to the right-hand side there, it's almost sick of sort of repeating this now in a sense, but it just keeps coming through. You can see there just on those stocks alone, just on their index weightings, that's cost us about 250 basis points. Turning now to the macro, and certainly this is one of the things we've been talking about in our participation in this current FPA roadshow. There are sort of two things happening here. If you go back to the post-GFC and that macro setting, which favoured the sort of momentum we've been talking about, there was quantitative easing and low interest rates. So we're at a stage now where quantitative easing is turning to quantitative tightening, and interest rates have now started to turn. So that's kind of interesting. So the very environment that's favoured the buying of these momentum stocks, could it be that we're going to look back in a year or two's time and say that 2018 was a period where those macro settings reversed? So quantitative tightening and interest rates now starting to rise. And that really brings me to this next overhead. And this is, you may have seen this before, this is what's called a global wave, and it's done by one of the, what I think one of the preeminent equity strategists at Bank America, Merrill Lynch. The global wave, as we've noted in the footnotes there, it's basically a conglomeration of various measures of economic activity: output, demand, productivity, wages, manufacturing prices, credit spreads, and earnings expectations are the key ones. So key indicators of how the economy will be moving. And we know that over the course of the last 6 to 12 months that the world's been moving into synchronized economic growth. And we also know that, as cycles can be quite long. And so, arguably we're in the very, very early stages of synchronized economic growth, which probably means, therefore, that interest rates continue to rise over time, and the quantitative tightening continues as well. Now, that's an environment where investors, looking back on history, would start to move away from the sort of stocks that have driven the market. And so that style chart is quite interesting in that sense. Could we start to see a reversal back in favour of value, sort of from here on in? And then we sort of drop down to the domestic economy. I think what's been interesting about the domestic economy is that certainly up until around about early this calendar year, whilst economic growth was picking up, the domestic economy wasn't picking up to the same extent, which is kind of interesting because at the end of the day, the Australian economy largely over the medium term follows world economic growth. So as world economic growth has picked up over the course of this year, the domestic economy, the rate of growth started to pick up as well. I won't go through all of those points there, but certainly there are a range of measures there that indicate the domestic economy, is in quite good shape. I think one of the more interesting one there is the bottom one there. Who'd have thought, going back 12, 18 months ago that the iron ore price would have been where it is now, for example. So very positive for terms of trade in terms of the Australian economy. Turning to overall valuations, and this is a question I'm asked quite a lot. How's it looking? Well, it's interesting. This is the long-term PE. If you go way back to 1990, PE of 14.5 times in the market at the moment. It's only trading on 15.3. So, as we say, their valuations look reasonable. However, it is very bifurcated, isn't it? Picking up our earlier points there, there's kind of been two distinct groups of stocks have been at limited number of sort of high growth but very, very expensive stocks, and then the rest, if you like, which is where we've been trawling. So if one was to back those stocks out and look at the sort of the environment and the sort of PEs and the stocks that where we trawl in terms of that Triple style, then that group of stocks is trading below the long-term average, which I think is a means of reassurance. Digging a bit deeper and just giving you a sense of the portfolio. So that's the past, the sense of the portfolio and as it stands now. And I won't go through all of these stocks in the interest of time, but as you know, we're very much bottom-up stock pickers. And it's quite an interesting mix of stocks there. There's large cap stocks there. There's mid cap stocks. There's resources. There's industrial stocks there. We'll talk. I'll get Steve to talk to one or two of these stocks in a minute. New Farm, for example, is a stock that Steve's actually the analyst on. He's been following this company for many years, and it's a stock that Steve's brought to the portfolio. So we'll talk to some of those stocks in a minute. But on the resources side, there, BHP and Woodside Petroleum have done quite well for us of late. In the last little while, last couple of weeks, we've just taken some profits in both of them. They've had good runs. It's always good to take some profits when they're there. But which brings me to the again digging a little bit deeper with some of these stocks. I think one of the key messages in this is that we do see very good value in the portfolio. Perhaps another way of looking at this is that the resources have run quite hard. The sector of the market that's run really hard has really been the second tier resources. Stocks like AWC, Iluka are two stocks that come to mind. Stocks that we've only had, we haven't had a lot of exposure to. One or two other value managers have, and they've worked well, which is fine for them. But I don't know. I just can't help but think that run's now over. You look at those second tier resources stocks. Gee, they've had big runs. Is the run in those stocks over? Maybe not. Hard to see where they get re-rated from here. So I think one of the key messages there, which is really partly embedded in this overhead here, is that a lot of good quality industrials are really in the sort of space where we trawl have been left behind. So I've always been a great believer when looking at stocks on a clean sheet of paper. If we didn't have this group of stocks, would we put them into the portfolio? And the answer clearly is unequivocally yes, because we see a range of good businesses there for good value. And I think that's a very, very important point. And I'd be the first to acknowledge that our results haven't been the way perhaps we'd like them to have been over the last little while. And to the extent that people might be contemplating whether or not one should continue investment in our fund, you'd be selling this group of stocks, and this was where the valuation is, and it'd be a bit like us saying, okay, we don't want to own these stocks, let's sell them. I mean, clearly that's madness. So I think that's a key message. The value in the portfolio and in the market we see predominantly in these industrial type stocks, and hopefully we've given you some examples there. So I suppose it could have been that we look back in a year or two's time and say, gee, I really did sell that fund, and therefore by definition sold those stocks at the very bottom. And as we've been talking to investors over the last month or so, some of the feedback I've been getting from investors and advisors is that some seem to be a little bit underweight value. And when we tell this story, one of the questions that they're sort of posing is, gee whiz, given the value that you've been talking about there, perhaps we should have a greater exposure to value rather than going the other way. What I'll do now is just hand over to Steve for a couple of minutes just to touch on New Farm and Macquarie. and then I'll come back and complete the conversation. Steve.
Good morning, everyone. I'll just give a little bit more colour on two of our bigger holdings, New Farm and Macquarie. So starting with New Farm, it's a really interesting business, and has a lot of things to like about it. And in particular, it's basically an agricultural stock, so it's not tied to your normal economic cycle. So the things that are driving a lot of the other parts of the market tend to not have a big influence on New Farm. What it is, it's effectively the world's second largest manufacturer and distributor of generic or off-patent crop protection chemicals, pesticides, herbicides, fungicides, etc. And it's a business which actually started off in New Zealand many years ago and grew rapidly through acquisition over a long period of time. But where it's evolved to now is it's a very strong platform in a way for distributing not only its own products, but also products of other manufacturers who don't have a distribution footprint. So it's very well represented in all the major global cropping areas, North America, South America, Australia, and Europe. So it has this very strong distribution footprint, which can be really leveraged as you increase the volume going through it. They've made a significant acquisition recently, which increased their presence in Europe very significantly. And we also really like the management here. It's a business, as I said, which has grown through acquisition, and its management didn't really keep up with its growth. But in the last few years, we've had a new management team who've really professionalised the operation of the business. So we see some strong EPS growth over the coming years, and also it's in a consolidating industry, and it's potentially a very attractive target. It's got some big strategic shareholders on the register who one of whom took their stake many years ago at over $11.65. So there are people out there who see the strategic appeal of this business as well as the near-term earnings outlook. So moving on to Macquarie. Now, Macquarie Group is another one of our significant holdings. It's been a very good one for us over the last year or so, and indeed over a number of years we've been in and out of the stock and done well from it. What we like at Macquarie is really their adaptability and diversity at the moment. But in particular, when we look, as we all know, they do have that leading global position in infrastructure investment management, and we know that globally that is just a growing asset class to be involved in. And in particular, the area where they're seeing some strong growth is in the renewable space, and they made the acquisition of the Green Investment Bank, which was a UK government-owned renewables financing vehicle around a year or so ago, and that significantly increased the scope of their platform in Europe, where the renewables growth is particularly strong. And being Macquarie, it's all quite integrated and interrelated, and in the Macquarie Capital business, they're moving down up the chain, and they're increasingly getting involved in actually originating renewables processes. So they're not just queued up like all the other funds trying to buy a wind farm when it comes to market. They're getting in there at the brownfield stage, buying the dirt, buying the turbines, permitting and building these things. So we think, once again, they're really adapting to the environment they're in. You look at their banking and finance business in Australia, which is growing strongly, and I think that's well positioned to do well out of the changes that we may well see out of the Royal Commission. So it's had a very good run, but we still think it has some good earnings growth potential going forward.
Thanks, Steve. And so one of the things just to reinforce, which I think is an important point, is that the strong capital preservation features in the portfolio as well. The balance, and that really comes from two factors. The first one's balance sheet strength, and as you know, we spend a lot of time looking at financial statements, so strong balance sheet characteristics of the holdings in the portfolio. And then the second part of obviously the capital preservation feature lies in the valuations, i.e. not paying up. And we know that we've got two stocks of equal standing, one on say 15 times, another one on 30 times, and something goes wrong with both of them. The one on 30 times falls a lot further typically than the one on 15 times. So I just thought it was worth mentioning that. In terms of portfolio positioning, just to talk just a wee bit more about that, we've covered quite a few stocks already. We always like to have some offshore earners in the portfolio if we can. Again, they've got to be good value and good businesses, and that just gives you a flavour there. One of the really interesting things about these days compared to say 15, 20 years ago is that investing in an Australian shares portfolio by by default can give you quite a good exposure to offshore markets, and you can see we have that through some of the stocks we've mentioned there. We've just touched on New Farm there. We've tended, as I've mentioned earlier, we've tended to have focused on the large cap resource stocks. Diversified financials, we've touched on Macquarie there. Jonas Henderson, we think it really has lagged. We've got a high regard for Andrew Formica there, who was the CEO of Henderson. He's now the co-CEO there. We think there's a very good value there. Then one of the other two interesting themes, the last two there, tourism and leisure and in infrastructure in the context of the Australian economy, the Asian tourist influx, Chinese tourism, although that just seems to have peaked for the time being, albeit off very, very high levels, it must be said. Pleasingly, we can get a range of exposures there as well. Interesting that infrastructure theme in many ways is a global theme, isn't it? It's both very much alive here in Australia and also globally. And for Lendlease and Macquarie, we can get both exposure both locally and offshore. And Steve talked about Macquarie a few minutes ago. Banks are always a topic of discussion, aren't they? It's a sort of tricky, the banks, that we don't feel strongly either way. We don't feel strongly either way at the moment, which is a little bit frustrating. But on the other hand, the yields are quite attractive. Grossed up yields, so the cash dividend yield plus franking credits, around about 8.5% for the sector. They have underperformed. But on the other hand, so that makes them somewhat attractive. But on the other hand, and Steve's the analyst on the banks as well, and his profit forecast for the banks going forward over the next 2 or 3 years, very muted earnings growth, 2 or 3% at best. And then underweight, typically, those of you who know us well, will know that we've typically had an underweight in those expensive defensives, which brings me to the portfolio characteristics. I've always believed that if you've got whatever style of investing you have, that it's important that you can show both to yourself and to your investors, more importantly, a set of numbers that illustrates that you've been true to label in terms of what you do. A number of you have seen this before. I won't go through the details, but you can see some valuation measures across the top there, and price to free cash flow, for example. The overall stock market's trading on a price to free cash flow of 15 times. The portfolio there is trading at about a 14% discount to the market at 13 times there. And you can see the premium discounts below there. So we can always show that we are delivering a true to label value portfolio. In terms of our numbers since inception, I always think it's important to go back and look at since inception numbers. And of course, this goes way back to really the beginning of the century. It's a long time ago now. But we have added value over that period of time. As I did say very early on in my introduction, we've more or less matched it with the market over the last 5 years at a time when it's been difficult for a value investor. But we have that's the longer term picture, and I think it's always important to look at that longer term picture. But sort of brings me to the conclusion and to summarise some of the points we've covered. An improving global growth outlook, upward movement in interest rates, QE reversing to QT. The domestic economy picking up. We talked about strength in resources there. We think that might moderate a little bit. We have been taking some profits there. A defensive high growth stock, still very, very expensive. But as we've hopefully illustrated to you, there are a lot of very good quality stocks that have kind of been left behind and are trading at good to attractive valuations. And so the two key points following on from that, we do have strong conviction in our current portfolio holdings, and that capital preservation feature I talked about before remains very strong and very much embedded in the portfolio, around balance sheet strength and valuation. So that brings an end to the presentation, and Caesar, I guess, hand back to you perhaps.
Thank you, John. Thank you, Stephen. We thank you very much for participating in today's webinar. We do have a question here before we wrap up. A question for either John or Steve. Appreciate your true to label, but where to from now?
Yeah, sure. So again, I suppose we sort of touched on this over the last half hour or so, it's just always hard to know what markets are going to do, isn't it? But look, I think a couple of reassuring points. 2 points on the sort of the top down and the bottom up. So we could sort of look at it in 2 parts. If you look at the top down and those macro settings that we've talked about, which have been in place for close to a decade now, i.e. since or post GFC, very much in favour of the sort of stocks and the momentum investing we've seen. Are we and now interest rates turning up and QE turning to QT, quantitative tightening. Will we look back on 2018 and say this was a turning point? I guess more generally for value investors in particular, it's hard to predict, isn't it? But certainly if one looks at the macro signs, it seems to be heading that way. So I think one of the key messages there is that for anyone who's fundamentally underweight value, and I am a believer in long-term cycles, anyone who's underweight value in terms of constructing a portfolio of fund managers, perhaps that's time to readdress that to the extent you might be underweight. Which brings me to the bottom up in terms of stocks. Where to from here? When we talked about a whole lot of stocks there that we think are good businesses. We've been following many of these companies for many years, and we think there's good value there as well. And you sort of say to yourself, what could be a catalyst to re-rate these stocks? Well, it's often the fact that they're just simply too cheap. That's often a catalyst, and the more expensive those expensive defensives become, then perhaps that'll start to encourage people to look at some of these better value stocks. Because as I said earlier, when we talked about the market PE, they're just over 15 times. It's a very bifurcated market. You've got a limited number of, it must be said, very good quality, but very expensive stocks, twice the market multiple. And then you've got a group of stocks that we're trawling in that essentially are trading, as we saw there, at a discount to the market. So hard to predict exactly where to from now, but when you think of those top down and bottom up factors, that should give some sort of means of reassurance, I would have thought.
Thanks, John. Just another question here. John, you make a good case that perhaps this is not the time to give up on value. Would you be kind enough to comment on, I guess, some the Perennial portfolio versus some of those other value peers in the market?
Yeah, I sort of always happy to talk about our portfolio, and others can take a view on other portfolios. But perhaps the only comment I would make is that one or two other value portfolios that have had a very good run out of what I'd sort of call the mid-cap material stocks. Iluka would come to mind. AWC would be another stock that comes to mind. There have been one or two others as well, of course, over the last 1 to 2 years. And that everyone's got a different style of value, and that's a good thing. I'd look, as I said a few minutes ago, I just can't help but think that, 2 points. Those second tier resource stocks, they really can jump around. I mean, they can be very volatile over the medium term. And when one looks at the tremendous run that they've had over the last 1 to 2 years, depending on which stock you look at, you'd kind of intuitively have to think that the big gains have been made there. And it turns to my earlier point there, that when I look at the market overall, big gains being made in those mid-cap resource stocks, good gains in the biggest stocks there. We've been taking some profits there, but we've still got them as core holdings. But the real value, I think, Caesar there, to finish off on that question, residing more in the sort of the industrial area of the market where we're trawling at the moment.
Thank you, John. Thank you, Steve. Ladies and gentlemen, thank you very much again for joining today's webinar. You will receive an email with a copy of the presentation, and